My name is Michael Guyad, publisher of the Lead Lag Report. The special guest for the hour is Darius Dale, 42 Macro. So let's get started here. So, Darius, there's a lot that I think we can talk about, but let's first go with setting the stage for the audience as far as who you are, what you've done, and what you're doing now.
Hey, absolutely, man. Appreciate you, buddy. So thanks for everyone for joining. I'm Darius Dale. I'm founder and CEO of 42 Macro. Consider ourselves, and I think a lot of other folks consider us one of the top macro risk management firms out there. We're only a year old, but a pretty historic track record on the sell side. So excited to be with you guys today.
Let's talk about risk off for a moment and what that term is, because I put
Oh,
this
you don't want to start by buying the dip, my friend?
No. I want to sell the rip, man. So, by the way, can I just say something about that? That term "buy the dip" has always bothered me, because to buy the dip, it assumes you have cash to buy the dip, which means you never bought the prior dips, right?
Mm-hmm.
Which is just anyway. I get cat. That's different than dollar cost averaging, obviously. But okay, so I put out this tweet when I saw futures took a hit last night, and I saw yields collapsing, which we haven't seen in a while, where you have high volatility in stocks go down.
Mm-hmm.
And there actually is a flight to safety in treasuries. I want you to talk about if you think that we may be re-entering, let's call it a classic risk-off period, where you see that kind of behavior as opposed to what's been this horrendous correlation of sequence of returns with stocks and treasuries both losing money.
Yeah, can I take a step back and
please. Let's
go 30,000 foot and then drill down into sort of the current setup. I think the simplest way to think about this year and the risks we see are just basically the mirror image of what we saw from pretty much the spring of 2020 through, let's call it, mid 2021. In that particular time period, you had five things that almost never happened together all coalesced to generate some pretty outsized excess returns in risk assets, credit, equities, commodities, crypto, et cetera. Those things were growth accelerating, inflation accelerating, corporate profit growth accelerating, aggressive balance sheet expansion out of the Federal Reserve, and aggressive fiscal policy expansion out of the Treasury. There's been 10 quarters, at least prior to the 3 quarters we saw from Q4 of last year, 2020, through the first half of 2021. Prior to that, there had only been 10 quarters since 1960 where all 5 of those things were happening. And as you might imagine, those are about 10 of the best quarters you've ever seen from an asset market response perspective. So no wonder we got the bubbles that we saw. And if you think about the sort of drivers of those bubbles all coming unwound here with, basically 4 of those 5 now moving in the wrong direction. Inflation's likely peaking here in the second quarter. And so by the third quarter of this year, we'll have all 5 of those things moving in the exact opposite direction. And as a result, you'd be a buffoon not to expect the exact opposite from a market pricing standpoint. And so that's sort of where we are today, is this sort of process where the markets are trying to digest the changes in a lot of those variables and trying to ultimately understand where they're going from a terminal destination standpoint. I think the growth outlook is still very much up in debate. Inflation outlook is still very much the number one debate, but I don't think there is any debate anymore with respect to where fiscal and monetary policy are being taken. And I think at least by the time we get through the second quarter earnings this year, maybe not this quarter earnings season, but by the time we get to the second quarter earnings season, which will be reported throughout the third quarter, it'll be pretty clear that the earnings outlook is pretty dour as well. So kind of taking it to where you are now today, is there anything you want to hop on before we get into the current setup?
Well, I will maybe add real quick to that view that inflation is either peaking or peaked is, I think, counter to what most people believe. And I say that because I put a poll out, I think it was last week, and I asked that very question, right? Has inflation peaked? And the vast majority of people said no. So is it one of those things where, okay, you can't really argue that inflation decelerates because the Fed has just raised rates by 25 basis points. There's other dynamics that are causing that peak. So let's talk about that, because to me, what's been remarkable is that the dollar's appreciation has done much more to tighten liquidity than the Fed. The collapse in bond prices from a total wealth perspective, as yield spiked, did more to damage the inflation narrative than the Fed, right? So talk through how you think about that.
Yeah, absolutely. So on the inflation side, I think from just mechanically speaking, the base effects really start to kick in April. So it's going to be increasingly difficult from that point forward to show acceleration on a year-over-year basis. But from my perspective, I don't think that actually matters. I think what matters is the impulse in inflation continues to run much hotter than where the year-over-year numbers are. And so that's at the bare minimum, that tells you that we're likely to settle once we get through this sort of digesting the base effects that we have over the next kind of year or so. We're likely to settle down at a much higher level of inflation relative to the Fed's target relative to anything we've been used to in the last, previous cycles. So just a couple numbers on that. If you look at headline CPI, obviously we're, tracking at 8.5% on a year-over-year basis. When you look at it on a 3-month annualized basis, the 3-month SAR is 11%. That's the fastest number we've seen on a 3-month SAR basis in September of 81. When you sort of get away from headline and say, okay, what's everything within the basket doing? Median CPI, the 3-month SAR is at 6.4%. That's an all-time high rate there. That's about 200 basis points higher than the current year-over-year metric. Sticky CPI is at 6.6% on a 3-month SAR basis, fastest numbers we've seen in 30-something years. The momentum in inflation time series in the U.S. and in a lot of economies, particularly in Europe, continues to accelerate to the upside. Now, whether or not base effects mechanically drag the number down, the year-over-year numbers down in the kind of coming quarters, I think is beside the point. The reality is the Fed continues to lose at the margins from an inflation fighting standpoint, and so that gives you a general indication of how far we might be away from a dovish pivot, which, in our opinion, is the kind of thing you need to see to get asset markets to stop misbehaving.
Although I do wonder if you're talking about a dovish pivot, if the market would actually see that as a positive. So I kept on floating this idea out last year that the risk is not that inflation lasts. The risk is that actually it is transitory, because in the context of all of the stimulus, it would suggest that no amount of money is able to create and force secular inflation in terms of the right kind of inflation, which is what the Fed wants on the wage side. If you think that the surprise may be that the Fed actually has to do an about face, which is, if you're going to that narrative, do you think that puts even further risk to this idea that the Fed really does control things? Because I don't know, if their only tool is to raise rates and they lowering rates create inflation for a moment of time, but the wrong kind of inflation, it seems to me that faith in the Fed gets even more questioned that way.
Yeah, no, I think that's a fair characterization. I don't disagree with it. I will say that I think that just as it relates to balance sheet expansion and the net liquidity function in the economy between the Fed and the Treasury, there is a mechanical sort of impact in terms of removing supply of duration, removing supply of Treasury bonds out of the private sector balance sheet, and allowing that sort of asset swap, if you will, between bank reserves and higher yielding assets within the banking system that causes stocks to go up, cryptocurrency prices to go up, just risk assets in general to go up in valuation when those mechanical sort of functions out of the Federal Reserve and out of the Treasury are being undertaken. And so, whether or not we have confidence as investors in the Fed's ability to kind of create growth or create inflation, I think, we've seen so many of these cycles before where I think we're all starting to get the joke that the Fed does not create growth. It does not create inflation. The Treasury Department's responsible for that. And as long as the Treasury Department either plays ball or does not play ball, we can pretty much get to the right answer on that front pretty quickly. And so as long as, I think it goes back to, is the Fed's balance sheet expanding? Is the Treasury general account, declining or falling? And are those two numbers moving in unison or moving in lockstep to drag over the overall net liquidity function of the market higher or lower? And it's our job as investors to predict the kinds of dynamics in the economy that will cause those types of variables to change. And right now, the dynamics in the economy that are causing those variables to change are causing them to change in a very negative way for asset markets.
So let's go back to that prior point, if sort of the historical behavior of treasuries comes back in, because if the argument is that treasuries and stocks have been selling off because of very high inflation, well, if inflation comes in faster than people think, then you'll have more days like today where you see very long duration treasuries rally, yields drop, and the S&P is down big. But I want you to talk through the role of treasuries when you think about high volatility periods. If you think that is still going to be the kind of preferred asset class by institutions, maybe some individual investors, or if you think that legitimately the role of treasuries as the flight to safety haven, if that's just gone for now.
Yeah, great question. So I don't think it does depend on the level of inflation. So I don't know why, but at least empirically, when you study sort of the relationship between stock and bond prices, that an inverse correlation that we've all got super comfortable with, the entire sort of asset management industry has been kind of rebuilt on it over the last sort of 25 years or so, which is this negative correlation. That correlation really was perpetuated by inflation being persistently below what we've observed empirically to be the sort of 5% threshold. Now, I don't know why 5% seems to be the threshold, but at least when you're above that level, you typically have a positive correlation between stocks and bonds, and you below that level, you typically have a negative correlation. It's obviously not a magic, dividing line in the sand, but so as long as we continue to trend on inflation that's significantly north of that, you would expect not to see that sort of inverse correlation that, again, is the sort of foundational principle upon which many portfolios are constructed. Right now you're sort of having that classic risk off day. And in our opinion, that's the market finally saying, hey, look, maybe this bigger lockdown situation in China might be big enough to have a meaningfully outsized influence on inflation statistics over the medium term. Now, again, we're one day into potential Beijing lockdowns. So I think it's pretty early to kind of make a call like that. But I do believe that this is, that is an incremental catalyst in the sense that, hey, this is something that is exogenous that may actually knock inflation back down in check much faster than what's currently anticipated by as a function of what the Fed's kind of got forward guided us to, and also as a function of what the dollar's already done from a degradation of global asset demand or global demand perspective.
I've been very public in making this point that when your risk off asset is treasuries and they're not acting risk off, and your opportunity set is either risk on equities or high yield or risk off treasuries, and the two are acting the same, doesn't matter what you do, you're pretty much screwed, right? No matter what, right? So in my world, I need that convexity. Now, let me push a little bit on this line of thinking I've seen on Twitter, which is that, well, you've got this crisis now, potentially a currency crisis with the yen. I've seen some argue that, well, that may mean that Japan has to sell treasuries, or that China, in sympathy, would have to devalue the yuan, and that might have other impacts on treasuries because a lot of the mechanism for currency movement is ultimately around flows around U.S. government debt. So I want you to talk through your thoughts on what is happening with the yen, Japan, and what the implications might be on U.S. bonds in particular.
Prior to Kuroda effectively quadrupling down on yield curve control, this might have been a little bit of a different conversation because the range of outcomes is open-ended. I think it's a lot less open-ended now after the last couple of weeks of commentary. But, just taking a step back, kind of explaining to those of you who might be new to these dynamics, the BOJ, or at least investors in the JGB market, have been effectively sort of, prior to at least last week, have been very aggressively betting against the Bank of Japan's yield curve control policy. So right now they're capping 10-year JGB yields on a nominal basis at 0.25%. And this is as a direct function of their sort of policy initiative, which is to try to engineer inflation. I mean, I'm sure most people know that Japan has been in some form of in and out of deflation for about 2 to 3 decades now, and so none of that is new. We continue to just get incremental data points out of Japan. We got inflation data, I think, last Thursday or Friday that showed their preferred measure, the BOJ's preferred measure of inflation, accelerated 20 basis points to 0.8% year over year. It's still 120 basis points below their target. It's obviously very different from an inflation fighting standpoint or reaction function standpoint than all the rest of the sort of G4, G5 central banks. And so Japan, as a function of this sort of desire to sort of actually create and perpetuate inflation, BOJ has been very aggressive in terms of expanding its balance sheet and maintaining its yield curve control policy. Again, going back to my initial comments, there were a pocket of investors in Japan in the JGB market that said, hey, no, look, inflation's coming, the yen's going down. We got to effectively front run the BOJ revising this upper boundary of the BOJ's yield curve control higher, obviously lower in yield, in bond price, higher in yield. That ultimately did come to fruition. Kuroda came out and was effectively quadrupled down on that policy. And as a function of doing that, you're now putting I wouldn't necessarily say a floor because it's not the only thing driving U.S. bond prices lower. But certainly you've removed one peg from the Jenga board that is the bear case on U.S. Treasury bonds. So if you think about the ultimate risk to Treasury bond prices from a big sharp revaluation lower in JGB prices would have massive implications considering that Japan is the world's largest creditor account nation. It's got the world's largest net international investment position. And oh, by the way, it's our biggest creditor if you look at the TIC data in terms of who capitalizes our U.S. government from a foreign balance sheet perspective. And so, now you're basically saying, hey, look, we don't have to worry about as much selling pressure in the JGB market, which ultimately translates to selling pressure in the Treasury market. And so that, in our opinion, is one of the reasons why you're seeing, this sort of inverse covariance between stocks and bonds kind of come back into the fore. It's no surprise to me that it's happening after the BOJ sort of triple down or quadruple down on yield curve control.
I wonder if you think yield curve control is a possibility in the U.S. And I say that because if long rates were to continue to get out of control, I would argue the U.S. government's credit quality has to be downgraded. I mean, you may already be at that point to begin with. So the Fed has to keep money flowing on the long end, not so much on the short end, right, in order to not have some sort of cataclysmic bond market situation. But what are your thoughts on this idea that it's inevitable that the Fed's going to have to, at some point, step in with something more aggressive, like a yield curve control, like a return of twist or something like that?
Yeah, oh, no, without question, they're probably going to have to. I think this is the dividing discussion of our time, which is, does the Federal Reserve realize that it needs to capitalize the U.S. government or not? And in our opinion, we go through these cycles, and this has been the case since the GFC. I don't think anyone has worded it as eloquently as I've just done. I'm not sure that I've worded it as eloquently as it ultimately is going to be worded, which is there's just a massive hole of capital out there as it relates to the size of the government's deficits and the amount of demand from investors to capitalize those things. They're obviously very poorly yielding on a real basis, and generally speaking, you have the bifurcation of the world. From a geopolitical standpoint, is only going to continue to put downward pressure on the supply, the sort of foreign reserve stock out there. And so ultimately, we need someone or some entity to come in and plug those gaps. And the problem with inflation right now, and more importantly, the problem with asset markets, is that inflation is preventing the Fed from plugging that gap. And so we are now in a scenario right now, at least until we get a big enough slowdown or a big enough hiccup in asset markets, which in our opinion, we're nowhere near the size of hiccup we ultimately expect. If you think about risk asset prices in general, the Fed is very much going to be sort of out to lunch with respect to these dynamics until, again, we see something that scares them enough to get back very much engaged and capitalizing the government. Right now, they're trying to get us to capitalize the government. As you can see, that it creates problems. We have to sell stocks, we have to sell Bitcoin, we have to sell this, because at the end of the day, U.S. Treasury Department is at the top of the world's global capital structure. It's going to get the capital it needs. It's either going to get it from the expansion of the central bank balance sheet, or it's going to get it because we have to sell their assets and make room for that incremental valuation. So when you ask me about whether the Fed is going to ultimately do something that looks like yield curve control or try to sort of indefinite balance sheet expansion to capitalize the government, I think that is where we're headed longer term. It's just I don't think the Fed is, either because of inflation or just because of their they're very, very academic. I don't think they have these types of discussions, quite frankly. I just don't think that they're there yet in acknowledging their role in capitalizing the government and the fact that they can't really step away without a big issue in asset markets.
I'll take a stab at being more eloquent on that way you worded it, in saying that I think the best way to phrase it is that we are all fucked. Right? In terms of the system. Just overall, I think to me that's the most eloquent way to explain that. But let's continue down that. You said it correctly, right? The highest on the capital structure. So what's crazy to me, and I understand it's more duration, obviously, than anything else, but you would think that which has the highest claim on assets, the U.S. government, should, even when you factor in duration, be one of the best areas for conservative investors. And I'll tell you why I'm saying that. I was looking this weekend at some of these ETFs and funds, which are asset allocation funds, right? And they break it up by conservative, moderate, and aggressive. And really all that is sort of a mixture of changing the weightings of bonds, credit quality, and stocks. And when you look at a lot of these conservative funds, they have a big exposure to the aggregate bond index, which has a decent amount of treasuries. So I'm looking at the conservative portfolio, which has more in treasuries, more in bonds than stocks. And I see that almost all of these funds are below, after dividends, after coupon, are below the COVID crash lows of March of 2020. Meanwhile, the higher risk asset allocation, moderate and aggressive, are still above it. Why? Because they don't have the treasuries. So it's a long-winded setup. But what are your thoughts on how people should think about risk tolerance here? Maybe this is a little bit late to have this discussion because maybe treasuries now act like the flight to safety trade. But this year, I think, has clearly proven that what you think is safe may end up not being safe at all.
Yeah, no, and that's certainly been the case this year. I mean, that's one of the lessons I've had to relearn, teach myself, or reteach myself as well. I mean, we were sort of on the wrong side of the Treasury move, at least through through kind of mid to late March as well. We got out for the worst of it, but certainly, if you look at the historical relationship between stocks and bonds, and more importantly, how bonds have historically traded in these types of environments, growth slowing, tightening into the growth slowdown, both fiscal and monetarily, you typically have a positive excess return, a very outsized excess return in the long end of the Treasury market. Now, obviously, again, we're in this inflation regime, which we've all had to relearn. That's a little bit different than most of those back tests would tell you in terms of both the back test that I just highlighted, but any back test that obviously those types of firms or those types of funds are anchoring on to get you into those allocations. So this has been it's been a regime shift at the margins relative to kind of I guess this is sort of this regime we had been in the post-crisis era, but I would argue that regime really extended itself to the mid-90s when we first got into this disinflationary regime. But going back to one thing you mentioned, I think is important to call out, which is you and I talk about this all the time. We've had plenty of discussions about this, about sort of the general sentiment out there relative to positioning and how those are two very different things. I think positioning, as it relates to the treasury market, right now, if you look at the flow of funds data, in terms of how we aggregate the various components, investors are as underweight bonds and sort of fixed income type products as they have ever been. And they're conversely, as a function of that, they're as overweight equity type of products and exposures as they've ever been right now, to the tune of about 30% of total net worth. I mean, that's a pretty damning number if you think about, okay, who is left to go by the dip? Who's left to go, if we start to see the same kind of problems in stocks and credit on a delta adjusted basis, on a volatility adjusted basis, as we've seen in the treasury market, which we would argue, again, we haven't even talked about the outlook yet, but we would argue it's a high probability outcome, then who's left to buy the dip and at what price? Everyone's already sort of to a large degree, at least from the flow of funds data, it suggests that everyone's already all in and we're all going to be selling. Not all of us, because we've done a lot of selling already. We're 49% cash currently in our portfolio construction. And, that's probably going to go lower over the medium term, not as a function of us buying the dip in stocks and risk assets, but mostly as a function of us starting to reallocate and gross up our exposure to treasury bonds.
By the way, isn't that amazing? I mean, remember the hunt for yield? I mean, that was a term you'd always hear on the road. I mean, I when I was talking about my strategies to different advisors, and they say, what's the yield? What's the yield? My clients want yield. And now you actually have yield, and people are like, well, fuck this, right? I mean, it's a very strange, and it's not unusual. I mean, if you understand behavioral finance and investor psychology, it's just amazing how they don't like it when it's done very well. They don't like it when it's done very poorly.
Yeah, no, I mean, that's a tough crowd to please. I mean, that's neither here nor there. But look, we're human, we're emotion. I mean, this goes back to my favorite book is Thinking Fast and Slow by Danny Kahneman and Amos Tversky. And we're humans. We're behavioral creatures. We chase charts. That's it. That's as simple. You don't even have to read the whole book. Just figure. It's kind of the summary of the book. Your brain is wired to chase charts and hang on narratives. And so ultimately, I think the big narrative right now, as it relates to kind of why markets are at 4,200 and not 3,300 on the S&P 500, is the fact that the U.S. economy and the global economies are still resilient enough to kind of withstand, at the bare minimum, kind of what's currently priced into money markets, et cetera, from a financial tightening standpoint. We disagree with that view. We have a variant perception. We think the economy is going to start to slow at a much more significant pace throughout the summertime and throughout the fall. And ultimately, we're going to wind up in a place where the Fed is going to have to do that, about face that dovish pivot. And so if you think about how this could play out in asset markets, you start to see more days like today, more weeks that look like, kind of what we saw late last week and then today. And ultimately, you get to a place where the bond market will start to bet on the dovish pivot, but it knows that it won't. The stock market knows that it will come until it gets to a certain level. And this is what happens at every one of these intervals, right? And the bond market always sort of sniffs out the kind of pivot from the Fed before the stock market does, because the stock market has a lot of other factors that are kind of weighing on it, right? You still have people delta hedging and institutions, being on the different sides of those trades that kind of create much more of a song and dance function in the stock market and as a function of the stock market, the broader risk assets. But ultimately, they're going to go where the fundamentals take them. And the fundamentals just aren't on growth and inflation, their own policy and their own positioning. And none of those things are positive right now. I can't make it. I'm not trying to sound bearish, but if you have a rate of change process that is systematic and designed to be dispassionate and kind of just give you clean signals, the summary of those clean, dispassionate rate of change signals are all really negative.
And arguably one of the most important rate of changes to look at is how the rate of change in credit spread movement is behaving, right? That high yield sells off while treasuries again get that flight to safety trade, or at least on a relative basis that they could both be losing money, but high yield at a faster pace, duration adjusted. So I want you to talk through the way you think about the bond market separate from treasuries. Is there an underpricing and overpricing of default risk premiums given what you think might be coming? Talk about how much of that yield should be adjusted for inflation versus how much it should be adjusted for default risk.
Yeah. So just in terms of like how we think about the broader economic cycle. So, I think one of the things I was actually shocked about how quickly this came to fruition, but one of the things we were talking about in January at the beginning of the year, I said, hey, look, I think one thing that when we finish 2022, there's something we're going to be all talking about that we're not talking about today, and the word was recession. And I think the reason I said that was that we were starting to see evidence of sort of inventory build, and just given kind of the natural progression of reopening the economy, you could very easily get a run of the mill sort of inventory correction style recession. These are the more kind of less scary recessions, if you will. If you think about it, the response from asset markets, it's something like what we saw in 2001, where we only had a 70 basis point decline, peak to trough in GDP. We were starting to see risk of that at the beginning of the year. Now, I don't think the risk of that is gone anywhere. In fact, it's likely gotten a lot worse. If you look at some of the shipping and trucking data that we're monitoring real time, it's looking like we're having a real, pretty material slowdown in that pocket of the economy. We're not, we're certainly not there yet in terms of actually realizing it on a coincident to lagging indicator basis, but certainly some of the leading indicators are pointing us in that direction. So, whether credit spreads, to go back to your question on credit spreads, I don't see a lot of traditional leverage cycle risk in the economy. And one thing we look at to monitor that is the sort of the change in the credit to GDP ratio. We look at on a 3-year Z-score basis, just to kind of show like there's a big gap, big deviation from the trend. Typically, what happens if you have a big positive deviation from the trend in the private non-financial sector credit to GDP ratio, or either the household sector or the corporate sector, what typically happens in that process is you get a lot of adverse selection. Banks and entities, financial entities, started making really bad loans to borrowers who have low propensity or the likelihood of ever repaying that debt. And so we don't have that. That's not a real feature of the current economy, nor have we seen a significant tightening of financial conditions through the debt service ratio. Right now, the debt service ratio, in terms of its deviation, is not signaling anything that's been particularly draconian yet. Now that'll change a year from now when we're refreshing that BIS data. It'll be very different a year from now. We could potentially have something that looks like that. But again, I don't think, once we get to that point, it's very likely that we'll be closer to the end of the tightening cycle as opposed to closer to the beginning of the tightening cycle. So that's my long-winded way of saying, hey, look, credit's going to go down as a function of a lot of the broad risk off that we see coming and are currently engaged in asset markets. But it's certainly not something that we would expect to see look like 2008 or some 1987 or something like that.
I want to go back a little bit to Europe. You mentioned momentum in Europe, or rather the lack thereof. And it seems strange to me that anyone could possibly believe the ECB will ever stop buying bonds. Okay. And the reason I'm saying that is, you have that suddenly you might have a return of the pigs, right? Which is what we saw in 2011, this kind of concern around Portugal and Italy and sovereign yields like that. But also, I think it's become very clear to European leaders that they have to do some real serious infrastructure around energy to not be so dependent upon Russia, in particular for gas, right? And maybe restart sort of nuclear power plants. Talk through how you think about Europe as an investment case, which it really hasn't been for the last decade. But is there anything that would ever result in sort of a reason to say, okay, I really want to follow and invest in Europe as opposed to the US? Or is this just one of those things where it's like Japan, it's just going to be a nothing area to put money to work in?
Yeah, no. So you're going to get an opportunity to invest in Europe. I think we're still very early in the process of finding a good price for that. So I wouldn't be doing that today. But it's pretty clear that the likely response out of policymakers across the pond is going to be one of incremental fiscal stimulus, to address what I see as two crises in Europe. One is the energy insecurity crisis. One is the physical insecurity crisis, and not necessarily places like Germany or France, but certainly closer to think about places like Poland, et cetera, et cetera. So you're going to see the amount of money that Europe spends on military, the amount of money that Europe spends on securing physical commodity needs and physical commodity security. Those numbers are going to go up. Now, are they going to go up tomorrow or next month? Probably not. So we probably need to see some incremental pain in asset markets and in the economy to effectively light a fire under the of the European authorities. And this is the process that plays out globally. You don't just get money from the heavens from fiscal and monetary authorities. Bad, for lack of a better word, bad shit has to happen first. And this is always been my problem, just sitting in the seat and having these discussions with investors for such a long time. It's just, look, you can't go from peak of the cycle, stock market's overvalued and everything's fine and dandy with earnings, to, oh no, the Fed will bail us out. Well, there has to be a drawdown in between there in order for the Fed to bail you out. And so I think that's kind of the case with Europe as well, is that, look, until we get inflation back under control, and oh, by the way, everything you all feel about inflation in the U.S. right now is orders of magnitude worse in Europe. Europe's inflation is at all-time highs, at least according to the sort of the harmonized statistics. But if you look at it on a surprise basis as well, I'm looking at the city U.S. inflation surprise index. That's right at 50 right now. The city inflation surprise index for the eurozone is at 274. Let me say again, the U.S. inflation surprise index is just shy of an all-time high, around 50 right now, and the eurozone is at 274. The 10-year German Bunds at a 5 sigma move on a trailing 3-year basis, whereas the trailing 3-year on a 10-year Treasury somewhere around 2.5 sigma. So there's a big deal in terms of kind of the inflation impulse that we're seeing in Europe and the likely fiscal policy response. And I think that's one of the reasons we're seeing so much more of a sell-off in European sovereign debt, particularly on the kind of previously negative yielding front. But ultimately, I do believe that that's something to be faded and sold. But again, at this particular, we're not at the place where we want to be buying bonds right now, and we're certainly not at the place where we want to be, increasing our exposure to risk assets. Will the Fed do this? I think it's two questions. Will they do it, and do they want to do it? Do they want to do it? I would argue probably yes. I mean, it'd be a lot easier to run an economy hotter, with the higher nominal GDP and all the other good stuff, because at the end of the day, all you really have to worry about at that point is financial stability. But the reality is, as a function of their mandate, they're not allowed to do that. So it's really, at the end of the day, it's really not what the Fed wants, it's what Congress wants. And if Congress ultimately gives the Fed leeway in terms of revising its inflation target, which it has not done yet, or at least that's something that's set by the Fed, but clearly they're being given direction by Congress, looks like above trend or below trend inflation. And so, if you think about most polls, if you look at consumer confidence, be it University of Michigan or the Conference Board or Gallup, inflation is the number 1, 2, 3 issue for most Americans. And so, to me, I think this would be the precise wrong time. I know, at least based on the commentary we got out of Messer, we got commentary out of Bostic 2 weeks ago, and I want to say John Williams as well. Over the last 2 weeks, we've gotten commentary from 3 regional Fed presidents that effectively said, "Hey, look, we're not of the mind to change the 2% inflation target, or the average inflation target. We're not going to revise it and sort of effectively admit defeat at this stage in the inflation battle." And so, at the bare minimum, I think we're probably going to have to see if they're going to opt for effectively allowing for a sustainably high level of inflation for a longer duration. I think that's likely to come after we see some pain in financial markets, that gives the Fed at least political air cover to opt for that. But right now, we are still so early in the process in terms of them fighting inflation and getting away from being so far behind the curve that I don't even think this is no offense, I just don't think it's a moot. I think it's a moot discussion at this point. This is certainly one of the worst cycles I've ever seen in terms of all the data we've looked at. I mean, you start from a growth standpoint. We're going from above trend to pretty clearly below trend. Let's call it 2 to 3 quarters from now, potentially into recession. So not only are we going to a bad place potentially, a very bad place, but we're doing that from a very, very elevated starting point. And so, not only just the direction of travel, but just also the magnitude of the change is so great. I mean, you just kind of throw some layers on that. So we backtest everything that ticks in financial markets through the lens of our grid regime process. That's kind of how we think about regime segmenting the world from a risk management perspective. And what really matters not only is what regime you're in terms of understanding the likely asset market dispersion, but also sort of the style of the regime you're in. You can be in a what we call inflation or deflation. That's where growth's decelerating in both of those regimes. Kind of at a modest pace of deceleration, and historically, that's giving you a kind of a flattish return in the stock market. Well, when you start to go from a modest pace of deceleration to something that's more moderate, you go to something that looks like down 10% on an annualized return basis for the stock market. When you go to something that looks like a much more meaningful pace of deceleration, you go from, let's call it down 9 annualized to down 29, down 30. And that's where we're headed for the second half of this year. Is we'll be multiple months of -2 sigma delta deceleration from a growth perspective. So that in and of itself should get you something that potentially could cause a stock market crash. Like, you don't need a recession to get a stock market crash. I don't know that stocks represent return-free risk at this point, because I do believe there is a credible bull case. I don't think the credible bull case has nearly as much sort of heft to it as the sort of very credible bear case, but I do want to articulate it. If inflation, let's just say the kind of general consensus narrative is that inflation is out of control, and it goes down a lot. Well, let's say we see several days or weeks or months that looks like this as a function of, kind of the China, Chinese COVID dynamics getting significantly worse. And, we basically take crude oil from 100 something a barrel to 80 something a barrel and keep it there. You're going to have inflation come down much faster than what's currently priced into consensus models or Bloomberg consensus is on inflation estimates, and certainly where the Fed is with respect to their summary of economic projections. That will inflate real consumer incomes and stave off a more meaningful growth slowdown. Do I think that's the most likely probable scenario? No, I don't. I don't think the inflation impulse is done at this particular juncture. But if it is done and it comes down really quickly, you're going to get something that looks like Goldilocks in the economy and in asset markets. So definitely be aware of that.
Although real quick, before you finish, I thought, Darius, it is interesting, right? Because if you do have a setup for a crash, as I always say, the conditions for one, and the crash actually happens, that's going to be a deflationary shock.
Yeah. Well, you could have a deflationary shock, but it could also be a very positive dynamic. If you go back to, one thing that's been really weighing on kind of the overall economy, right? We're talking about 1% on a SAR basis for GDP for Q1. One thing that's weighed on that is the decline or the slowdown in consumer spending. On a real basis, the 3-month SAR and headline and PCE is only 1.3%. That number could go easily back to 3 to 4% if we shave, 2 to 3 basis points off, through 2 to 300 basis points off of inflation. And, just in terms of inflating real consumer incomes on a per capita basis, real disposable personal income is minus 3.4% on a 3-month SAR basis through the month of February. Like that's a recessionary number that could easily go to something that's very non-recessionary if we see inflation break down. Now, again, that's a big if, because I don't think that's the modal outcome. The modal outcome is everything we've been talking about in terms of the business cycle risk, the valuation risk of the market, and ultimately the positioning risk associated with the market into a growth slowdown that is of significance. And so in terms of going to answer George's question, what do people do? I think this question has two answers. If you're an institutional investor and you can't take your ball and go home and you're forced to deal with it, then the obvious solution is to be in the kinds of sectors and style factors that typically outperform in inflation and deflation, particularly with growth slowing at a fast pace. It's no surprise. It's the utilities, consumer staples, healthcare is, I wouldn't say all REITs. There's a lot of dispersion in the REIT space, but just from a sector perspective, REITs tend to do reasonably well in there. It's not your favorite tech companies, unfortunately. It's certainly not high beta cyclicals. It's not value. I know a lot of folks have been hiding out in that stuff this year. Those things will get tattooed if we go into a sharper deceleration in growth as we anticipate. So the reality is, if you're an institutional investor and you can't take your ball and go home, that's it. If you're a retail investor or an RA investor, you can take at least a portion of your ball and go home. That's the obvious solution. Why bang your head on a wall trying to pick sector and style factor dispersion in a year where the market could be down 20 to 30%? You should just watch it and eat popcorn.
Although popcorn's going to be a lot more expensive price of it. But hold on, but that's actually a good transition. It's actually a good transition because I feel like I can't do a space without talking about food prices, commodity prices on the soft side, the ag side. Have you done any work or anything, kind of looked at anything recently that would suggest that food prices are not going to be as elevated as people think, that it may end up being, yes, more expensive, but not to the point where there's what we've seen already, ongoing riots in emerging economies?
So our signal on ag is currently neutral. Obviously raging bull from a price perspective, but the volatility dynamics in the market continue to suggest that we are not in a raging bull market. There's something afoot. And clearly the something afoot is, one, the geopolitical headline. The geopolitical story could change on a dime and be either really incrementally supportive or incrementally negative. I think that's one thing that's weighing on it. But also, it's pretty unclear, like where we're going to get the incremental supply, or if the incremental supplies are going to be come or not, right? I mean, so if you think about wheat, for instance, we're kind of still in this kind of potentially positive window where we're not worried about, kind of the wheat supplies, for this year, because they've already been planted. I guess getting them out of Ukraine might be an issue, but the real issue for wheat will be next year, or not next year, but into the winter, and whether they'll be able to sort of plant, that type of wheat. And so I don't know. I'm certainly not an ag analyst. I don't have time to do global macro and ag. It's quite a big job, but I certainly don't believe that if you run out of, let me take a step back and just make the final point. If you run out of positive sort of momentum, and more importantly, a supportive narrative for energy and ag, this whole darn thing is gone. The whole thing is going down, and it's going down a lot. Because if you think about like what's happening today in financial markets, this is the first sort of real, truly risk-off deflation style day that we've had in a while, where investors are really sort of just reducing risk broadly and indiscriminately across asset classes. And that's the kind of market you typically see. That's the kind of price action you typically see in a market crash. If ag and crude oil, with the bullish and fundamental backdrop as they have, just from a supply perspective, can't work, then nobody's favorite stock's going to work. Nobody's favorite credit's going to work. This whole thing is going to get completely toast. And I hate to sound so aggressively bearish, but it just is what it is. That's the setup.
Which means we can't really have toast. If
that's the which is also getting very expensive, by the way.
Right. I jokingly tweeted out, it's like gluten-free diets are going to make a hell of a resurgence with this kind of environment. So I'm curious. So let's talk for a moment about the research you do, Darius, at 42 Macro. And I'm going to assume, correct me if I'm wrong, that a lot of your subscribers are institutions, financial advisors. I'm sure you also have retail, but I am curious when you have, and I see this a lot myself with the lag report side of things. I am curious if you see that there's sort of sentiment that comes from your own subscribers looking at your own research. If there's pushback around a thesis, if that makes you believe that maybe you're onto something, talk through that dynamic in terms of feedback of clients, because I've seen this many, many times where people that follow me that would agree with me when I'm bearish then completely disagree with me when I'm bullish. And it's almost because I don't agree with them. All right. Mm-hmm. So talk through that a little bit.
Yeah, no, we've been really blessed at 42 Macro, man. We have a phenomenal group of clients. I'm not just saying that to blow smoke. I would say the very opposite if it was true. But no, the reality is, like, I get a lot of really, really good feedback from our clients. Sometimes I'll buy something and change the portfolio construction. I'll be like, oh no, you're early on that, and they'll be right. And they'll be like, oh, and I'll make a change. Sometimes I'll book a gain or I'll book a small loss in something. I'll be like, yeah, that was a good move. Yeah, we sold that yesterday. We sold that too. So it's a great community of really thoughtful people to be in. I mean, it's a very diverse community. I mean, I would say we're somewhere around a third in terms of institutional investors, buy side mutual funds, hedge funds. Then there's another third of, let's call it RIA type investors, and then another third, let's say retail, high net worth individuals, crypto. I got for whatever reason, I think the millennials have latched on to me as the macro guy. So I have a lot of folks who kind of only trade crypto as well on the distribution list as well. So it's been a blessing, man, to get a lot of different feedback and a lot of audiences. And I would say, I have clients who sort of educate me all the time on some of these dynamics. It's almost like having a second research team, if you will, because people say, "Oh, have you seen this? What do you think about that?" You think about that. So I tend to think that we're in a good position from that perspective. What do you think?
Yeah, I think that's largely true, because obviously if somebody's paying, also they don't want to insult the person they're paying, too much if they disagree with them. But I think you're right. Although that's maybe an interesting direction to take the remaining 7-8 minutes here, which is how in the hell do you apply macro to crypto? And I'll tell you why I'm framing it in that way. I think the issue that's not really understood is that it seems like you constantly have these different correlation regimes when you look at Bitcoin relative to other risk assets and other crypto, and you have periods where it seems like they're diversifiers, and times when it seems like they're just a levered play on beta. We have clearly not seen this narrative that cryptocurrencies are an inflation hedge, as investments can also not be inflation hedges like we're seeing now. Talk through your framework of how you think about the macro environment and the asset class of cryptocurrency overall.
Yeah, no, absolutely. So it's if it takes, it matters, or macro is going to influence. This we know, right? If it's a liquid asset vehicle, particularly a vehicle that relies on speculation and institutional and incremental adoption. I mean, in order to have incremental adoption, you need the economy to be growing, you need wages to be growing, and you need credit to be getting created. So what are all the sort of underlying drivers of that? Like, you can sort of peel the onion back and kind of get to how and why you need to have a macro risk management overlay to trade crypto well and profitably. Obviously, you can just dollar cost average and not care about drawdowns, but the reality is, anybody at or near retirement, or anybody on the institutional money management space, that's the end of their career, that's the end of their retirement. So, for those folks who understand who need to have a more kind of a risk managed approach to the asset class, that's where we come in. I mean, at the end of the day, there's no difference between Bitcoin and the stock market or treasury bonds or gold or the dollar or some other financial product. When you're back testing things to a rate of change perspective, you can see how these different influences in the economy and asset markets and respect to policy have an influence on crypto. one thing we talked about earlier in terms of the growth slowdown in the economy and how that's likely to go from something that's flat to positive for the stock market to something that's deeply negative. That same growth slowdown is much more pronounced in crypto. So when you're talking about having a modest slow growth slowdown for Bitcoin, that's like a 0% annualized return, so no kind of a flattish expected return. When you head into a more meaningful growth slowdown or something, what we call it minus 2 sigma delta, particularly when you're in deflation, which is what we'll be in the third quarter of this year, that's minus 64% on an annualized basis. So it's trying to understand what we're really trying to do with 42 macro. I think is the simplest way I describe what I do is understand what's changing in the economy in terms of the things that matter, the principal components of influencing asset class returns, growth, inflation, policy, positioning. Those are the 1, 2, 3, and 4 things you got to get right. Understand how those things are changing at the margins and whether or not we're going to go from a positive state for a particular asset to a negative state or vice versa. And right now we're going from let's call it a middlingly positive or negative, let's call it flattish state for Bitcoin to something that's much more significantly negative, 3 or 4 months from now. And so that's kind of how we think about it from a crypto standpoint. Obviously it's not just Bitcoin that we care about. So all the major liquid ones.
Yeah, and it goes back to it's ultimately all one big trade because it's all driven based on liquidity, right? I mean, at the end of the day, I think when you look at the cryptocurrency space, arguably there's probably a lot more leverage than people realize because the idea is if you hate fiat, well, then you want to take as much fiat as you can and go as aggressively into these digital assets. But then when that liquidity breaks, then margin calls live also in the metaverse, in the digital space.
You said something in passing that I'm surprised that you didn't. I guess I don't know if we can hear people listening to us, but I'm surprised more people didn't gas and boo you out of the room. You said it's all one big trade. I happen to agree with you, but I'm not sure that the folks in the crypto space agree with you yet. They will after the end of the cycle, in my opinion. But certainly between now and that, I think we're going to have to, continue to knock on doors like Jehovah's Witnesses and try to convert them and recruit them into understanding what macro risk management means, what changes in central bank balance sheet means, what changes in fiscal policy, deltas mean, what changes in growth and inflation mean. All this stuff matters. And, when you're in a raging bull market, again, as a function of all those things, it's easy to convince yourself that it's always the brilliance when you're in a bull market and then blame macro when you're in a bear market. But I don't think the average investor realizes it was the macro that causes the bull market as well. And I'll say all those same macro dynamics that cause, $50,000, $60,000 on the Bitcoin price chart are now moving in a direction that should cause something that looks like 28,000 over the medium term. And so to me, in my opinion, I think we all have to be humble as investors and understand that, hey, look, it's not our intellect when we're generating returns in so much that it's, not everyone else's fault when we're losing money. We all just have to understand that and just manage risk accordingly.
I shared at the top of the space the tweet I put out January 5th. I said, breaking Bitcoin, stocks, bonds, commodities. It's all one big fucking leverage trade. Right? I mean, it really is true. It's like, and that's also kind of an interesting thing to think about when it comes to how you frame correlations, right? So, for example, we know that when a stock that was not in an index gets put into an index, the covariance increases, the beta, gets closer to the index, right? Because now it's co-moving with a school of fish, a whole bunch of other stocks, even though nothing's changed fundamentally about the company, right? The beta itself alone changes just behaviorally. And it's always been remarkably how I think people in the cryptocurrency space underestimated the idea that the moment you institutionalize Bitcoin, well, now it behaves like other institutional assets. The co-movement then has to go to everything else.
100%. That's my number one thing. I've been saying this since September, October 2020. Is that the second you put this into an institutional portfolio, it's gonna be succumb to all the other VAR characteristics and VAR modeling that all the other assets are. And guess what? It's going to be succumb to all the other sort of risk management parameters that everything else. And so Bitcoin has a outsized down day or outsized up day. Guess what? Positions getting taken down, risk getting taken down. And investors, professional investors, particularly on the buy side, have to operate under risk budgets. And the things that determine your risk budgets are the volatility of the asset, the covariance of the asset with the other assets in the portfolio, the broader market. Those things really, those two metrics, volatility and covariance, always go up when you're in what we call inflation or deflation. That's where growth's slowing. And we're not only in that, we're going to be heading into a much more significantly negative version of that throughout the back half of the year. So that those vol and covariance matrices are going to go up. And the people who are not paying attention, they're still kind of levered long crypto, are going to have to feel that and suffer as a result.
One thing that's for sure is that markets are humbling. Doesn't matter what asset class you play. And I will say that to everybody in the audience, again, please make sure you follow Darius. One of the big reasons I'm a big fan of Darius is because he's wildly intelligent and also extremely humble, which is hard to find in this industry. Trust me, I know, having dealt with a lot of different people. So thank you again, Darius. Appreciate it.
Michael, you're the man, bro. You're one of the hardest working, more thoughtful, more galvanizing people in the FinTwit space, man. I really appreciate you having me today. And thanks everyone for tuning in.
Thank you, everybody. Cheers.